Well, I think compared to, say, for example, February, the balance must have shifted towards more financial stability. Not only because of Silicon Valley Bank, you saw First Republic recently. I think the ultimate point is that the economy is gradually slowing. You look at the job numbers last night. Again, the job numbers are still really robust. There's still a large number of job openings, but the direction is one of deceleration. So from that perspective, not only because of the financial sector, but also I do see some signs of softening, not weakness, but softening in the broader economy. So I think from that perspective, given the fact that interest rates are already pretty high, I think it makes sense for the Fed to, again, go 25 tomorrow or tonight, rather, and then pause for the time being. Now, what's interesting is that if you look at the Reserve Bank of Australia, they did stop and pause and then resume yesterday, which is a bit of a surprise. So I think we should not completely close the door on the fact that the Fed may need to react to strong inflation numbers or strong job numbers and then reopen more rate hikes. But I do think that with the current read of the economy, they should be done with this particular hiking cycle.
But how about reacting the other way to a weak economy and any potential further fallout from the banking crisis? We've got markets right now pricing in, I think, 50 basis points worth of cuts by the end of the year. Is that a little too optimistic?
I think so. I think the Fed's threshold for rate cuts is going to be incredibly high. And ultimately, we're still looking at inflation at 3.5 to 3.75% by the end of this year. We're not going to be anywhere close to its 2% target until 2024, maybe even 2025. So from that perspective, if we go through a mild recession in the US, that may not be sufficient for the Fed to start cutting rates. So either you have a mild recession scenario where the Fed is going to hold on to high rates for much of this year going into next year, or you have a much more severe recession that will force the Fed's hands to start cutting rates before end of 2023. But then we're not going to move only 50 basis points. We have to move a lot more. So I think the market pricing right now is neither here or there, neither pricing in a mild recession or something a lot more serious.
Tai, so tactically, what we're hearing a lot is if you are managing a global portfolio, then you want to reduce risk towards developed markets, including the US, and start buying into Asia and emerging markets. Does that make sense, given where we are in the cycle?
I think so. I think if you look at the growth momentum, if you look at policy support, there's very clear divergence between what's happening in the US and Europe, where things are decelerating. If you look at some of the PMI data out of Asia, while the Chinese PMI numbers may have disappointed recently, but the overall momentum in terms of consumption, we're starting to see some early signs of corporate investment coming back. All of that is going to be, in my view, supportive of both China and Asia and broader emerging markets. I do recognize that the Chinese markets have been disappointing so far, year to date, especially compared to the US. But I do think in terms of earnings outlook, there's a lot more upside potential for the Chinese market, for the Asian domestically focused companies compared to the US, which at the moment, the current earnings season is still reasonably decent. But I think the headwind facing US companies over the next 6-12 months is going to be quite significant.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to the channel for more. Thanks for watching.